Here we go, that's better. So this is the risk warning. So I just ask you to take a quick look through the risk warning. Excellent. Okay, now we're going to just have a quick look through what actually went on this week. I mean, it was looking to be a pretty positive week. You know, we've been scaling to fresh record highs. This is the NASDAQ that we're looking at here, scaling to fresh records highs above the 25,000, just short of 25,200. Before actually we had a sharp fall today following comments from Trump on his social media, Truth Social, for warning about additional steep tariffs on China, basically in relation to rare earths, which China may be looking to increase export tariffs on rare earths to other parts of the globe. So those comments from Trump have just really pulled stocks sharply lower. And we're seeing that in the NASDAQ. It was down around 2% at the worst point. That does mean that losses, we are now looking at losses across this week. Gold has obviously also been very much in focus this week, as we have seen it go to fresh record highs. And it did come off yesterday. And the reason that it came off yesterday was because of some strength that we saw in the US dollar. So just having a quick look at the US dollar here as well. This is some strength that we saw in the US dollar. Rose to a 2-month high, has fallen on those news of potential more tariffs, in the sense that it felt like we had very much got away from these tariff narrative, but it feels like it may actually be coming back. Now, the reason that we saw stocks rise last week in the US to record levels, that's the S&P 500 breaking out of that rising channel, but basically is because we've just had the market continue to grind higher on those expectations of you know, more Federal Reserve rate cuts. The AI trade has been very much in focus as well, and that sort of helped drive stocks higher. Obviously, like I've said, we've had that concerns over the tariffs, which has just taken out that rising trend line and the 20 SMA, breaking below that very, very near-term support of 670. So just adds in an element of uncertainty. So that's basically where we are as we head into the new week. Now, it's worth noting that next week there are a couple of things going on. Obviously, we have the Columbus Day on Monday, so that's the US bond market is closed, or stock market is closed, sorry, and bond market may be open. But we've also got the start of Q3 earnings season next week. So basically 68% of companies in the S&P 500 are expected to report by the end of October. Now, expectations for earnings growth to slow to around 6% year on year versus 11% in Q2. Now, we're expected to see that could be bigger if we see a stronger contribution from the Magnificent Seven. EPS growth is expected to moderate owing to reduced FX benefits, higher tariffs and one-time charges, but specifically earnings for the Mag 7 is expected to be around 14% growth, which is around half of that of earlier quarters. And obviously, we're going to see much focus on AI-related spending. But next week, as I said, kicks off with the banks, as we always see, very much in focus for their outlooks as well as sort of, you know, any suggestions of concerns that may be coming through, but I don't think we'll necessarily be looking at that from the banking sector. So this is the S&P 500. It's going to be very much in focus as earnings season kicks off. I think what we need to be looking for here is we've got that sort of fairly aggressive break below the 20 SMA and that falling trend line and that 6.7 level, and that opens the door to 6.570. That's the low that we saw at the end of September. That's the next level to be watching out for. Has brought the RSI out of overbought territory. So, you know, this isn't by any means a crashing out of the uptrend. This uptrend is still, you know, pretty much, I mean, it's been intact for a very long time now, since early May. But that's, some levels to be watching out for on the downside. But I think, this isn't at the moment looking to be anything too concerning. But levels to be watching on the downside after that is 63.50. On the upside, buyers are going to be looking to rise above that 67.65 level in order to buy fresh record highs at 6,800. So other things that we'll be watching: UK, we've got quite a bit going on as far as the data is concerned in the UK next week. So first of all, we've got UK unemployment rate, which is expected to hold steady at 4.7%, and we're also expecting to see earnings hold steady at 4.7%, which is still particularly sticky. It's not consistent with inflation falling back towards the Bank of England's 2% level. You need to see what earnings growth at around 3% in order to be consistent with 2% inflation. And recent data has showed that the labour market is continuing to weaken, although the pace of weakening has slowed, and that's something that is keeping the Bank of England away from getting overly concerned about the health of the labour market, particularly as inflation remains elevated. So I mean, I think the other thing to keep in mind is it's not going to, this data isn't unlikely to impact the Bank of England's outlook as far as rate cuts are concerned. With inflation still so sticky, even if the job market does weaken, it would need to be weakening quite considerably more than what it is at the moment in order for wage growth to slow and that to be able to bring inflation down. And we're just not seeing that right now. The Bank of England's not expected to cut interest rates again, potentially until April next year. And obviously we've also got the budget in November, so the central bank is not likely to be cutting rates at all just before that budget either. So this is the sterling US dollar. Now we have seen it fall below this rising trend line, which dates back to early April. It's fallen below there. We've taken out the 133.60, sort of a 133.30 support level. That's turned into resistance now, and that was on that back of that US dollar strength that I was talking about yesterday. If we get stronger than expected labour market data, then that could see the pound look to retake that level, especially if there are sort of concerns over the outlook for the US dollar. But I think, broadly speaking, the RSI here is below 50. We've broken below that rising trend line. So, the next step would be naturally to look towards the 200 SMA down at 31.70 to see, but it all depends how we react to this resistance, whether it continues to face rejection there or not. Just sticking with the UK, we've also got UK GDP, and for August, which is expected to show 0.2% month-on-month growth, up from 0% in July. Whilst the positive bias is encouraging in the sense that it's up from July, I think it's also worth noting that recent PMIs have been a little bit more concerning. So PMIs in August were actually very strong, which may help be reflected in the GDP paper, the data that we're going to see, the monthly GDP data. However, what we did note was that the PMIs in September were considerably weaker, particularly the service sector, which could continue to weigh on demand anyway for sterling, even if we do see that stronger than expected GDP growth. That said, any sense of stronger growth than forecast will be well received by the Chancellor ahead of that autumn budget, where we've really seen that there are concerns about the outlook as far as the Chancellor needing to raise more funds, particularly at a time when growth is pretty much stagnant. If she raises taxes, that's likely to slow growth further. So it's quite a conundrum. I mean, just today we saw that a certain think tank suggested that she should actually just increase income tax in order to help put the UK back on track fiscally. But that was a pledge that the Labour government promised they wouldn't do. So we just have to wait and see there what actually happens. So that we've also got Bank of England. Governor Andrew Bailey is supposed to speak on Tuesday. Fed Powell speech. We did hear from Fed Powell today, but this week they were welcoming remarks. They weren't anything of particular notice or importance. Now, interestingly, this would have been the main focus, would have been on US inflation. However, inflation is unlikely to be, in fact, it's not going to be released this coming week, because of the US government shutdown. It's going to be released in the following week, at the end of October. So that's not going to be the driver that it once was. Now, the Bureau of Labour Statistics has brought in some late workers to finalise the CPI report, according to Bloomberg reports. But yes, the ongoing US government shutdown, that's also something that the market's having to deal with. So it's quite a lot of factors that the market's having to weigh up. So, you know, it does feel that it was looking quite positive despite those factors. Now, we have seen that break below the 20 SMA here. As far as CPI is concerned, expectations were for a rise of 0.3% month on month, down from 0.4%. Obviously, this data now, we're going to have to wait for it until the end of October, but it comes after the FOMC minutes were released this week, and it did show that officials were divided over the policy outlook, with different views on inflation and the labour market. The majority see that weakness in the labour market could cool inflation, which would justify further rate cuts, which is why we've seen US stocks trading to record levels on that optimism of 2 more rate cuts this year. So let's just have a look at what else we've got going on. So we've got a speech, I think I've seen here, by ECB President Christine Lagarde. We've also got German CPI, although I don't believe that is the secondary reading. Let's just take a look at the euro US dollar, because actually the calendar is relatively quiet. Again, here we can see that it's fallen below the rising trend line there. It's taken out support, falling to around levels of the 115.42 level. That was like a 6-week low that we saw there, maybe. And the outlook is looking a little bit weak there. We'll see with the RSI is also below the 50 level. And this is basically, I mean, we've got that ongoing situation in France where the PM resigned last week, early this week on Monday. So there's, because they're struggling to get the budget through in France, so a budget which they need to raise taxes and cut spending, and it's proving extremely difficult to get through the very fragmented parliament. We're heading in for our 6th prime minister in just 2 years, and the budget needs to get pushed through, and it does look like it's struggling to happen, which is making euro less investable in, and as a result we've seen that sort of falling off of the euro. We've seen a recovery just at today after a week of selling off, and that's sort of and that's on the back of that US dollar weakness that we're seeing because of the new tariff fears. But levels to be watching out for as we go into next week. 114 could be the next level, which was the low that we saw back in August. And then on the upside, you know, if we can get a rise above sort of the 116 and 117 level, that's been proving to be quite a struggling point for the euro for quite some time now. I'm just going to have a quick look at US dollar Japanese yen, because this is another one that's been very much in focus, given the political situation and in Japan, where we saw the change of the leadership contest run by fiscal dove Sanae Takeichi, And as a result, we saw steep weakening of the Japanese yen this week to that 153 level. We have seen it just come back down because of the US dollar weakness on those worries of tariffs. And if we do see that as setting the tone next week, and we hear anything more from Trump around more tariffs on China, then we could actually see that come back down to test the 150, which is the level that that was last seen back in July, at the end of July. Because we could also see safe haven flows to the Japanese yen. There isn't much data, major data at all for Japan coming through. So that's not something to be too concerned about. We've also got US retail sales. Now, retail sales are expected to come in at 0.4%, up from down from 0.6%. So again, that's still pretty strong, given the everything that we've got going on. That still suggests that the consumer is still spending, despite sticky inflation, despite some weakness in the jobs market. The consumer is still happy to keep going. So that data, oh, hang on, it will likely be delayed. So sorry. Retail sales as well will likely be delayed, which I guess just leaves us to look at oil. Oil has fallen sharply. Now, that is basically a couple of things we've got going on here. So we've got the peace deal in Gaza, which is removing, we're seeing risk premium fade off oil prices, which is why we've seen that sort of sharp fall down. And then obviously anything that might concern a slowing in economic growth in China because of more tariffs means that we're seeing a real pull down on the oil price at the moment. As you can see, we just bear with me 1 second. There we go. We are in a downward trend anyway. We're below the 200 SMA, we're below the 50 SMA, we're below the 20 SMA. It fell this week to rise above that 20 SMA. Now we've seen this really quite aggressive break below some support levels, below the 60 level, psychological level. Technically, that does actually open us up to this area here, which is the 55.20, 55.50, which was the low that we saw back in the beginning of May. So if we do hear again more about these tariffs, potentially more tariffs on China, then and that's going to drive sentiment at the start of the week, then we could indeed see gold fall lower. China is as well the largest importer of oil, so any concerns of slowing growth there is going to be bad news. So that's really it. I mean, there isn't a huge amount. We've got Chinese inflation actually, so let's just have a look at that. That's going to affect oil as well. Let's just have a look at what's going on with the Aussie dollar as a proxy for China. So as far as inflation is concerned, I mean, disinflation has been a bit of an issue for China for quite some time. It is expected CPI to come in at 0.1% year on year in September. That's up from 0.4% in August. And on a monthly basis, it's expected to rise from 0.2% from 0%. PPI, so wholesale inflation, is expected to be up to negative 2.3% from negative 2.9%. So the PMI gauges, I mean, if we look at cost pressures from PMI gauges, we have seen that they intensified in September, but firms didn't actually pass on higher selling prices. They actually cut selling prices due to intense competition. So, the data comes basically, I think, as pressure is really mounting on Beijing to ramp up support to boost domestic demand and weakening exports. Now look at this. This is the Aussie dollar fallen very sharply, testing this support here at the 164.80 level. It's a level that we've tested on quite a few occasions. If we break through there, we're exposing the 200 SMA down here at 164.25, a level which we've seen come into focus twice in August. So they're going to be levels to watch on the downside. That's quite an aggressive breakthrough. On the upside, we'll actually be looking sort of around the 165.80 and then up to the 166.26 level in order to bring 167 into focus. But the mood would need to churn quite considerably in order to turn that around. At the moment, I mean, we are still sort of in a bit more of a neutral territory at the moment. So that is everything from me. I hope you've enjoyed it. And for more videos like this, I'll see you next week.